Let's get this thing started. Roll on one. All right, perfect. Yeah, that's a great question. So, why are most or all your trades have strikes out of the money? So, if you look at the diagram I just shared with you, right? You can see this is a comparison of risk reward ratio versus this is risk reward ratio versus win rate is what you're looking at. Okay, so I operate on a 3-to-1 risk reward ratio. That's my that's the ratio of choice for me. That to me that's the one that makes the most sense to operate with, due to the what's the correct way? Due to the way option contracts fluctuate, if you will. It makes the most sense because you have to give a little bit of you have to be able to give up a little bit on the option contracts, and as you've noticed, I'm sure, just to even be able to stay in them, right? So you can't it's very rare that you just get into a contract and then it just goes green and just stays green the whole time, right? So and you've noticed that, right? Because there's that fluctuation in the underlying price, and then the contracts, they fluctuate as well with it. But sometimes, that fluctuation may be a little bit more or less, just depending on what your strike and expiration is, etc. But the reason that I choose that specific risk reward ratio, if you will, versus win rate, so it's kind of like a happy medium, if you will. And by doing that, by giving myself I choose 35%, as you know. So giving myself a 35% drawdown on a full size as a maximum, once I'm fully sized into the position, that allows me to have that, 80%, I only have to hit 30% of the time to be profitable, right? And obviously we aim to hit way higher than that. Like, that's our goal, to have a higher win rate than that. But at the minimum, I only have to hit 30%. And with the way that I've structured the BFI method, you should be able to hit more than the 30% win rate if you're following the method. Like you're using your 4-hour zones, you're entering at BFI footprints, you're waiting for a valid signal, etc. You should have a higher than 30% win rate if you're trading mechanically. So, the whole goal is you want to be able to take the system that I have, the system that I have developed, and it should be repeatable and scalable for anyone. Anyone that joins this group should be able to take this method, apply it to their own account, and you should be able to hit way more than a 30% win rate if you're applying this style of trading. But why the strikes out of the money? So again, for the same reason, when you get more leverage when you go a little bit out of the money. So you notice that I don't typically swing for the fence. Like, we're looking at AMD right now. So like, we've been playing this like 58, 59, 60 contract both directions for literally weeks, right? Like, we've been playing this thing back and forth, like over and over and over again, right? But the reason why out of the money, or just maybe slightly out of the money, like, we've been playing like the 58 when we're at like 57 or 56. We've been playing the 57 when we're at like 59 or 58, etc. Why a little bit out of the money? Because the leverage, you get a little bit more percentage gain, if you will. And by having a little bit higher percentage gain on the contract, it allows those probabilities to play out for you in your favor, because you have to be right even less, if you will. So because like let's say I played the 56 contract when it was at 56, right? If I play the 56 contract and I run from 56 up to 59, let's say, so $3 move, right? The 56 contract might give me like, I don't know, maybe like 80%, right? Something like that, 100, maybe 90%. But like we've been playing like the 57 and 58 contracts, and even some of the 60 contracts as well, and like those have hit like 150, 160, even more actually. My lotto is actually on Friday. Where was it? Here. I had these 63 contracts here, and they hit twice. And actually, this move right here was a 500% gain on Friday. This was a 500% gain. So like that's like that's a 1 to 5 risk reward ratio. Just by playing a little bit out of the money. So even if I was wrong on that one play, I could run that play. I could run that play 5 times and only hit once out of the 5, right? I could only hit one time out of the 5, and I could just break even. So that's why I choose to play a little bit outside of the money, just to give myself a little bit more leverage. And that's why I play like that. But it also depends on the time frame though too, right? So you've noticed when I'm playing like 0 DT contracts, for example, right? Like when I'm playing SPX or I'm playing, I'll just use SPY. We'll just pull up SPY because I got lines up on I have more lines on SPY. So like we've been playing, this range here, and we've been, working with SPY. But like you've noticed with me, like let's say like Friday, right? Like Friday, I had the 385 contract, but I had it for Monday. But either way, even if I was playing a 0 DT, I might play, a 382 or 383. I don't swing like way out here, for a 0. So it also depends on the time frame. And then if it's later in the day, right? Like when we were over here, we took, actually, I think Corey's in here with me now. We took a 388 contract here, but that was only $1 away, right? So we took a 388 because it was later in the day. I'm not going to go as far. And maybe even if I was playing, okay, like here at the end of the day, we tried to make a move on this 390 short contract, right? But there's only 30 minutes left in the day. I'm not going to swing for like something that's far out. And instead of actually going out of the money or even at the money, I actually went in the money because I'm playing it safer based on the time frame and the contract expiration. So it just depends on what the scenario is, right, and what the time frame is. So, but the main reason, the biggest reason is I'm trying to increase that risk reward ratio, right? I'm trying to increase that risk reward ratio, and so that way my win rate doesn't have to be as high to be profitable over a series of trades. That's the simplest way to put it. That's the shortest explanation, but that's why I do that. So, and I've done enough structural and study and analysis on option contracts across like thousands and thousands and thousands of tickers to have that understanding of what makes the most sense from a risk reward ratio. Because I don't want to be like, if you look at this diagram, I don't want to be in a 1 to 2 risk reward ratio or 1 to 1 risk reward ratio, right? Because if I'm trading like that, if I'm trading 1 to 1, that means I have to have at least a 50% hit ratio just to break even, right? So that's to me, that's no good. Like I don't want that, So if I go 2 to 1, okay, it's a little bit better. I can go with a 40% win rate and I can be profitable at 40%. Okay, that's all right. It's better, but really, like to me, like the sweet spot is that 3 to 1, because it gives me that room to breathe on the contract, right? So if I'm sized in. If I'm sized in on a contract and I got $3,000 running, right? I can have $1,000, $1,000 and change of breathing room on that contract by the time I've scaled in, and that's a lot of breathing room in a sense, because the way I trade, right? I scale into my position, so by the time I I should say most of the time. Most of the time, when I'm scaling into a position, I do it incrementally, and you know that. I'll go 5%, 10%, 20%, all right, 40%, 50%. Okay, cool. The market sized me up. By the time I'm fully sized into a position, I'm already up 20, 30%. So by the time I'm fully sized by 20, 30%, and having that 3-to-1 risk reward ratio, that means the market has to move against me 50%, 60% to bring me to my stop limit. You see what I'm saying? Because I'm already up 30%, and now it's got to move that 30% to break me even, and then another 35% to stop me out. You see? So it has to move, and if it moves against you that much, you're probably on the wrong side of order flow at that point. But if the market has moved against you that much, you're probably on the wrong side of order flow. So unless you're trading 0 DTE, that's probably the only stipulation with that. Like the only one that's a position can move against you 50% and you're still on the right side of order flow. Because it's a 0. But for most case scenario, for like the contracts that we trade, if a position moves against you 50% and you even on a weekly, on a reasonable strike, you're probably on the wrong side. So, that's why I choose to operate with that 3-to-1, and that's why I choose to select the strikes that I select, because I'm trying to shift that probability farther in my favor. So, yeah. It's a long-winded answer there, but I wanted to give you a full explanation and give you a full understanding. So, good question, though. That's a great question. I will say, on that note, though, I will say that when I'm trading for longer periods of time, when I'm trading for longer periods of time, I actually tend to get even tighter on the strike side when the market is not as volatile the way it is right now. Because like before, for example, before the market had this crazy volatility, I might select a strike that's maybe like $1 or $2 out of the money, right? And then I'll just let it run for like weeks. I'll just because at that time, like the theta is not hurting me, and it's so deep in the money that like if you're, let's just like go back in time here, right? So like if you're trading, if you're trading this move here, like something like this, I might, if I'm over here and I'm buying in on this position here or whatever, at like 295, let's say, I might just let this run for weeks, and I might buy a 295 contract and just let it run, and just let the market do the heavy lifting over a period of time. And then I can just, whenever I'm ready to exit, I can exit stress-free, no stress, because the contract is $20 deep in the money, and I'm on the right side of order flow, and I don't have to stress about it, So I can just exit comfortably. So I don't have to worry about it hitting a certain strike by a certain date. I can just say, you know what? I'll gladly pay the extra money to buy the 300 or the 295 contract when it's at 295, knowing that there's a valid BFI footprint here, knowing that it's a valid retest that printed a signal. And I'm just picking a random spot on the chart, by the way. Knowing there's a valid BFI footprint here, knowing that I just printed a valid signal, even if I bought it over here, whatever, I'll wait for that valid signal to print, and then I let the market do the heavy lifting, and you can just buy that 295 or 296, 297 contract, and I just let it run for maybe a few weeks, all the way up to 300, 310, whatever, and by that time the contract is so deep in the money, you're up 2, 3, 4, 500% on a full size position, and you're completely relaxed in it, So, what expiration would you pick for that example? Typically, Chris, I used to trade like 3 week, 4 week contracts, like monthly contracts. I would trade on OPEX. Yeah, lies. Yeah, no, this is how I would rock. Actually, when we first started this Discord, I was still swinging. We were still swinging longer term trades. It's only in like this last like, basically since I started this Discord like right here, basically over this last like period of like from June to yeah from like June to October. This is where I've been like getting in it, doing a lot more in and out, in and out. Yeah, I know. Yeah, tell me about it, bro. Yeah, because the volatility is increasing too, man. Like you have this, like look at the way the volatility is increasing, right? So like if you're drawing your channel, right? So like this channel is getting wider and wider over time. These swings are getting more and more intense. So yeah. Yeah, no, I used to trade a little differently, but you have to be adaptable to the scenario or to the environment. Like look at the volatility here, right, in comparison, right? It's like this is like, super tight. The swings are much less chaotic, you know. And also, um, yeah, fire the questions away. What are the next supply and demand lines on SPY? So we're going to be basing this off of liquidity, right? First of all, right, that's our first step. So now that we're going to most likely have this technical breakout from 390, we closed at 3900 on Friday. Obviously, we do have a binary event though, right? You know that we have the FOMC this week. So, but the next place that I'm looking at, let me just pull this up real quick. So I think you're already with me on the Netflix short, Corey. I think you took that with me, right? I think so. Nice. Okay, so you're already leveraged short in a position that has a high probability of success. I'm just opening up my Thinkorswim desktop here. Give me 1 second.